The dollar's global grip, how it shapes your money. Alright, so welcome everyone. If you've ever wondered how the world of money works, especially when you hear about different currencies and international trade, then you've come to the right place. Welcome to our deep dive into the dollar system and its impact on global currencies. It's a topic that sounds complicated, I get it, but trust me, understanding this is key to understanding so much about the global economy, and even how your own money is affected in ways you might not even realize. We're going to break it all down, step by step, so it makes perfect sense. Today, we'll explore how the US dollar interacts with other currencies in the Forex market and its effects on international trade, investing, and finance. Think about it. Almost every major international transaction, from countries buying oil to you buying something online from overseas, has the US dollar lurking somewhere in the background. It's like the main character in the global financial story, and all the other currencies are playing supporting roles. We're going to look at why that is, how it works, and what it means for businesses, governments, and even regular folks like you and me. The goal here isn't just to throw a bunch of facts at you, it's to help you see the bigger picture and connect the dots. Because honestly, once you grasp how the dollar system operates, a lot of news headlines about the economy, international relations, and even your investment portfolio will start to make a whole lot more sense. So grab a coffee, maybe a 20-cent iced coffee if you're making it at home, stick with me and let's get into it. And hey, if you appreciate this kind of breakdown, do me a solid and gently tap that like button for the YouTube algorithm. It really helps out the channel. The dollar's throne. Understanding its reign in global finance. Alright, so first things first. What exactly this dollar system we keep hearing about? Well, in simple terms, the dollar system basically refers to the overwhelming dominance of the US dollar as the world's #1 primary reserve currency. This means that most central banks around the world hold a significant chunk of their foreign exchange reserves in US dollars. It's their rainy day fund, their stability cushion, and the currency they trust the most on a global scale. Think of it like this. If currencies were celebrities, the US dollar would be the A-lister everyone wants at their party. Beyond just reserves, the dollar is also the standard for global trade and finance. What does that mean? It means that a massive amount of international business is conducted using US dollars. We're talking about huge deals like countries buying and selling oil, gold, agricultural products, and even services. Many international loans, especially to developing nations, are also denominated in US dollars. It's the common language of money when different countries are trying to do business with each other, making transactions smoother and more predictable. Now, you might be thinking, okay, but why the US dollar? Why not the euro or the yen or something else? That's a great question, and the answer has a lot to do with history, the size and strength of the US economy, and the stability and liquidity of US financial markets. After World War II, the Bretton Woods Agreement effectively pegged other major currencies to the dollar, which itself was convertible to gold. Even though that system officially ended in the early 1970s, the dollar's momentum and the infrastructure built around it just kept going. So, most other currencies around the world are, in practice, measured against the US dollar. When you hear that the euro is up or the yen is down, it's almost always in relation to the US dollar. It's the benchmark, the yardstick by which other currencies are valued. This makes it easier for everyone to understand relative values quickly. If you know what your local currency is worth against the dollar, and someone else knows what their local currency is worth against the dollar, you can pretty easily figure out the exchange rate between your two local currencies. The fascinating part is that many of these international transactions, priced and settled in US dollars, happen even between countries that don't use the US dollar as their local currency. For example, Brazil might be selling coffee to Japan, and that transaction could very well be priced and paid for in US dollars. Neither Brazil nor Japan uses the USD domestically, but for international trade it often becomes the default currency. This reduces complexity and risk for both parties involved in the trade. This reliance on the dollar means there's a constant global demand for US dollars. Countries and international corporations need to have dollars on hand to pay for imports, to service their dollar-denominated debts, or just to participate in global markets. This demand, in turn, helps to support the value of the dollar. It's a self-reinforcing cycle, really. The more it's used, the more indispensable it becomes, and the more indispensable it becomes, the more it's used. Think about the sheer scale of this. We're talking about trillions of dollars flowing around the globe every single day, facilitating trade, investment, and financial operations. The US dollar acts as the main lubricant for this massive economic engine. Without a widely accepted currency like the dollar, international trade would be way more complicated, involving countless direct currency conversions, which would add costs and uncertainties. So, the dollar system isn't some formal, written-down set of rules that countries signed up to recently. It's more of an evolved, market-driven reality that has solidified over decades. It's built on a foundation of trust in the US economy, the depth of its financial markets, meaning it's easy to buy and sell large amounts of dollars without drastically affecting its price, and simply, habit and convenience. It's the path of least resistance for global finance. This central role also gives the United States a certain amount of influence, sometimes called exorbitant privilege, because it can borrow more cheaply and isn't as exposed to exchange rate risk for its own international transactions as other countries might be. But it also comes with responsibilities, as global economic stability can be significantly impacted by US monetary policy and the health of the US economy. It's a big deal, and it affects pretty much everyone. To wrap up this part, just remember this: the dollar system means the US dollar is king when it comes to international money. It's the main currency held by central banks, the main currency used for global trade like oil and commodities, and the currency that almost every other currency is measured against. It's the financial bedrock of our interconnected world, for better or worse, and understanding this is the first step to understanding global currency dynamics. Dollars and action exchange rates, Forex, and your wallet. Alright, now that we've established that the dollar is basically the boss of global currencies, let's get into the nitty-gritty of this system actually works with other currencies on a daily basis. This is where things like exchange rates and the Forex market come into play, and trust me, it's not as scary as it sounds. The first key concept here is currency exchange rates. Essentially, every single currency out there has a value relative to the US dollar. This relative value is what we call the exchange rate. So for instance, you might see something like 1 US dollar equals 0.92 euros, or 1 US dollar is worth 160 Japanese yen, or 1 US dollar can be exchanged for 83 Indian rupees. These numbers aren't fixed, they fluctuate constantly, sometimes by the second. These fluctuations are driven by a whole host of factors like supply and demand for the currencies, interest rates in different countries, economic stability, political events, and investor sentiment. It's a dynamic, ever-changing landscape. Why do these exchange rates matter to you? Well, if you're planning a trip abroad, say from the US to Europe, you'll need to convert your US dollars into euros. The exchange rate at that moment will determine how many euros you get for your dollars. If the dollar is strong against the euro, you'll get more euros, meaning your trip effectively becomes cheaper. Conversely, if the dollar is weak, you'll get fewer euros, and things will feel more expensive over there. The same logic applies if you're running a business that imports goods or sells products internationally. Next up, we have the foreign exchange market, or Forex for short. This is the marketplace where all these currencies are traded. It's the biggest financial market in the world by far, with trillions of dollars changing hands every single day. And guess what? The US dollar is involved in something like over 80% of all Forex transactions. That's huge. It's either one side of the trade or it's the currency through which two other less common currencies are exchanged. In the Forex market, currencies are traded in pairs. You'll see things like EUR-USD, which is the euro versus the US dollar, or USD-JPY, the US dollar versus the Japanese yen, or GBP-USD, which is the British pound versus the US dollar. These are some of the most commonly traded pairs. When you see a quote like EUR-USD equals 1.10, it means that 1 euro is worth 1.10 US dollars. So, if you wanted to buy euros, you'd be selling dollars, and that's the rate you'd get. Let's make this even more practical with a currency conversion example. Imagine you're in India, and you want to buy a cool new gadget online that's priced at 100 US dollars. We need to figure out how many Indian rupees, INR, that's going to cost you. Let's say the current exchange rate is 1 US dollar equals 83 Indian rupees. To find the price in rupees, you just multiply. $100 multiplied by 83 INR per dollar gives you 8,300 INR. Simple enough, right? But here's where it gets interesting. Let's say a few weeks later, the Indian rupee weakens a bit against the US dollar. Now maybe 1 US dollar equals 85 Indian rupees. That same $100 gadget hasn't changed its US dollar price, it's still $100. But for someone in India, the cost in rupees is now $100 multiplied by 85 INR per dollar. which comes out to 8,500 INR. So, just because the currency exchange rate shifted, that same product now costs 200 rupees more. This perfectly illustrates a key takeaway. A stronger US dollar generally makes imports more expensive for people in other countries when they have to convert their local currency to buy US dollar-priced goods. Conversely, if the dollar were to weaken, that $100 product would cost fewer rupees. This constant dance of currency values has a direct impact on the cost of goods, the profitability of international businesses, and even the flow of tourism. So you can see how these mechanisms, exchange rates determined in the massive Forex market, and the simple math of currency conversion are the gears of the dollar system. The US dollar sits at the center, acting as the primary reference point. Whether you're an individual buying something from overseas, a multinational corporation managing its finances, or an investor looking at global markets, these dollar-driven dynamics are always at play, influencing costs, profits, and values. Understanding this interplay is crucial. It's not just about numbers on a screen, it's about real-world financial impact. The price you pay for imported electronics, the value of your investments in foreign companies, the competitiveness of your country's exports, all of these are touched by the way the dollar interacts with other currencies. It's a constant flow, a constant adjustment, all revolving around the strength and movement of the greenback. Alright, so we know the dollar is the main player and we know how it interacts with other currencies through exchange rates and the Forex market. But why does the dollar hold such a powerful position globally? It's not just by chance. There are some very specific, very significant reasons. One of the biggest ones is oil. You see, for the most part, global oil sales are priced and settled in US dollars. This is often referred to as the petrodollar system. What this means in practice is that if a country, say Germany or Japan or India, wants to buy oil on the international market, they typically have to pay for it in US dollars. This creates a massive, constant demand for dollars from virtually every country in the world because almost every country needs to import oil to power its economy. Even if they're buying oil from, say, Saudi Arabia or Russia, the transaction is often still quoted and finalized in USD. This is a huge pillar supporting the dollar's global dominance. The origins of the petrodollar system go back to the 1970s, with agreements made between the United States and major oil-producing nations, particularly Saudi Arabia. These agreements essentially ensured that oil would be sold in dollars, and in return, the US offered security and investment opportunities. Given the sheer volume of the global oil trade, we're talking about billions of dollars worth of oil being bought and sold every single day. This system locks in a persistent worldwide need for US currency. Another major factor is global debt. A significant portion of international debt, especially debt issued by developing countries or corporations in emerging markets, is denominated in US dollars. So, when these countries or companies borrow money from international lenders, they receive dollars, and more importantly, they have to repay that debt, plus interest, in US dollars. This might seem straightforward, but it carries a big risk for the borrowers. If a country has borrowed in US dollars, and then its own local currency weakens against the dollar, the actual cost of repaying that debt in local currency terms goes up. They still owe the same number of dollars, but they need more of their own money to buy those dollars for repayment. This can put immense strain on national budgets and even lead to debt crises if the currency depreciation is severe. So the fact that so much global debt is in USD further entrenches the dollar's importance and creates another source of demand. Then, there's the role of central banks and their reserves. As we touched on earlier, central banks around the world hold US dollars as a major component of their foreign exchange reserves. Why do they do this? Well, for several reasons. Firstly, having a stockpile of dollars allows them to intervene in the currency markets to stabilize their own currency if it becomes too volatile or weakens too much. They can sell dollars and buy their own currency to prop it up. Secondly, US dollar assets, particularly US Treasury bonds, are considered to be very safe and very liquid. Liquid means they can be bought and sold quickly without significantly affecting their price. During times of global economic uncertainty or financial stress, investors and even other governments often flock to US dollar assets as a safe haven. This reputation for safety and stability makes the dollar an attractive currency to hold in reserve. This behavior by central banks creates yet another layer of demand for the dollar. If every major central bank wants to hold a significant portion of its reserves in USD, that naturally supports the dollar's value and its central role in the global financial system. It's like everyone agrees that this is the go-to currency for stability and for conducting major international financial operations, so they all act accordingly, reinforcing the system. So you have this trifecta: oil being priced in dollars, the petrodollar system, a large amount of global debt being issued in dollars, and central banks holding dollars as their primary reserve asset. Each of these factors individually is significant, but together, they create an incredibly strong and resilient framework that keeps the US dollar at the heart of global finance. It's a deeply embedded system that has developed over many decades. This doesn't mean the system is without its critics or challenges. Some countries are actively looking for ways to reduce their reliance on the dollar for trade and reserves, for various geopolitical and economic reasons. But dismantling or significantly shifting away from such an entrenched system is an incredibly complex and slow process. For the foreseeable future, the dollar's key roles in oil, debt, and reserves mean it will continue to matter immensely on the global stage. Alright, so we've talked about the dollar's dominance. Now, let's get into what happens when the dollar's value itself changes. The US dollar isn't static. It can get stronger or weaker relative to other currencies. And these mood swings of the dollar have very real and widespread impacts on economies, businesses, and even your personal finances. Let's break down what a strong dollar scenario looks like first. When we say the dollar is strong, it means that one US dollar can buy more of a foreign currency than it could before. For example, if the dollar strengthens against the euro, your $100 will suddenly get you more euros if you're traveling to Paris. This is great for Americans looking to go abroad or buy imported goods. Why? Because those foreign goods and services effectively become cheaper for US consumers. That fancy French wine or German car, the price tag in dollars might go down, or at least not rise as much. So for US consumers, a strong dollar generally means that US imports are cheaper. Companies that import goods to sell in the US can buy them for fewer dollars, and some of those savings might be passed on to you. It also means US tourists traveling overseas find their money goes further. However, there's another side to this coin. For US companies that export their products, a strong dollar can be a headache. If the dollar is strong, it means that US exports become more expensive for foreigners. Think about it. If someone in Japan wants to buy American-made software, and the dollar strengthens against the yen, they'll need more yen to buy the same amount of dollars to pay for that software. This can make US products less competitive in international markets. US companies might see their export sales decline, which isn't great for their bottom line or for US jobs in those export-oriented industries. Now let's flip it and look at a weak dollar scenario. A weak dollar means that one US dollar buys less of a foreign currency. So if the dollar weakens, your $100 will get you fewer euros, fewer yen, fewer whatever. This has the opposite effects of a strong dollar. For US exporters, a weak dollar can actually be a good thing. US exports become cheaper for people in other countries to buy. If foreign buyers need less of their own currency to purchase US goods, then US products become more attractive and competitive globally. This can boost US export sales, which is good for those businesses, and potentially for the US trade balance. However, for American consumers, a weak dollar means that imports cost more. That imported French wine or German car will now require more dollars to purchase. So if you're buying a lot of imported goods, a weak dollar might hit your wallet. What about the general impact on foreign currencies when the dollar is flexing its muscles or looking a bit tired? Well, as we've said, foreign currencies generally lose value against a strong dollar. This means that if you're holding euros or yen, and the dollar strengthens, your euros or yen will buy fewer dollars. This dynamic makes foreign goods cheaper for Americans, as we discussed, but it also makes US goods more expensive for people holding those foreign currencies. Conversely, if the dollar weakens, foreign currencies effectively strengthen against it. This makes US goods cheaper for foreigners and foreign goods more expensive for Americans. Central banks around the world watch these movements very closely. If their own currency weakens too much or too quickly against the dollar, it can cause problems like imported inflation, because imported goods become more expensive. In such cases, a central bank might intervene by selling some of its US dollar reserves to buy its own currency, trying to support its value. So you see, the strength or weakness of the US dollar isn't just an abstract economic indicator, it has tangible consequences. It affects the price you pay for goods at the store, the profitability of US companies, the flow of tourism, and even the decisions made by central banks around the world. It's a constant balancing act, and the dollar's mood sends ripples throughout the entire global economy. Understanding these effects can help you make more informed financial decisions. For example, if you're planning a big overseas trip, you might want to pay attention to exchange rate trends. If you're investing in companies with significant international sales, the dollar's strength can impact their earnings. It's all interconnected, and the dollar is often the key driver of these changes, simply because of its central role in the world. Alright, let's talk about something that hits close to home for many of us: investing. Specifically, investing internationally. You might think that when you buy a stock in a foreign company, you're just worried about whether that company does well. But there's a hidden player in this game, and you guessed it, it's the US dollar and its relationship with other currencies. This is a really important concept to grasp if you're looking to diversify your portfolio globally. So, let's set up a real-world example. Imagine you're a US investor and you've done your research and you decide you want to buy stock in a promising European company. Let's say a German car manufacturer. Their stock is listed on a European exchange and priced in euros. The first thing that needs to happen is your US dollars have to be converted into euros to actually purchase those shares. The exchange rate at that specific moment of conversion locks in how many euros your dollars buy. Now fast forward a year, let's consider scenario 1. The euro strengthens against the US dollar during that year. This means that each euro is now worth more US dollars than when you initially bought the stock. Let's say the stock price of the German car company, in euro terms, stayed exactly the same. It didn't go up, it didn't go down. However, when you decide to sell your shares and convert those euros back into US dollars, you'll actually end up with more dollars than you would have if the exchange rate hadn't changed. Why? Because each euro you got from selling the stock now translates into a larger number of US dollars. So in this case, even with a flat stock performance in its local currency, the currency movement, the euro strengthening, gave your investment an extra boost when measured in your home currency, the US dollar. This is a currency gain. On top of whatever the stock itself did, it's like a hidden tailwind for your investment. Now let's look at scenario 2. The euro weakens against the US dollar over that same year. This means each euro is now worth fewer US dollars. Let's imagine the German car company's stock actually did pretty well, and it went up by, say, 10% in euro terms. You're feeling good. But when you sell those shares and convert your more valuable euros back into US dollars, the weaker euro means you get fewer dollars for each euro. In this situation, the currency movement, the euro weakening, can actually eat into your stock gains. Your 10% gain in euros might translate into only a 5% gain in US dollars, or in a more extreme case, it could even turn a small stock gain into a net loss in dollar terms. This is a currency loss, and it can be a nasty surprise if you're not aware of this dynamic. It's a hidden headwind that diminished your returns. So, the big takeaway here is that currency fluctuations introduce an additional layer of risk and potential reward when you're investing internationally. It's not just about picking the right stock or bond. You also have to consider what the currencies might do. The performance of your international investments, when brought back to your home currency, in this case US dollars, is a combination of the asset's performance in its local currency and the exchange rate movement between that local currency and the dollar. This principle doesn't just apply to stocks, it's relevant for investing in international bonds, real estate in other countries, or any asset denominated in a foreign currency. The US dollar's strength or weakness against those other currencies will always play a role in determining your ultimate return when you convert back. For US investors, because the dollar is the global benchmark, most of these currency effects are viewed through the lens of how other currencies are performing against the dollar. Now, are there ways to manage this currency risk? Yes, sophisticated investors and institutions often use strategies like currency hedging, which involves using financial instruments to lock in an exchange rate and protect against adverse movements. However, hedging can be complex and has its own costs. For most individual investors, the main thing is to be aware that this currency effect exists, and to factor it into their thinking when considering international investments. Ultimately, understanding the dollar's role here is crucial. When you invest abroad from the US, you are implicitly making a bet not just on the foreign asset, but also on the future direction of the exchange rate between the dollar and that foreign currency. Sometimes it works in your favor, sometimes it works against you. But it's always there, a silent partner or sometimes a saboteur, in your international investment journey, all because the dollar sits at the center of these global currency flows. Alright everyone, that brings us to the end of our journey through the world of the US dollar and its massive influence on global currencies. Thanks for watching. We hope this breakdown helps you understand the crucial role of the US dollar in global finance. We've covered what the dollar system is, how exchange rates and Forex markets work, why the dollar is so important for things like oil and global debt, how its strength or weakness impacts economies, and even how it affects your international investments. It's a lot, I know, but hopefully it's much clearer now. The key thing I want you to take away is that the dollar's position isn't just some abstract concept for economists and big banks. It touches so many aspects of our interconnected world, from the price of gas to the cost of your next vacation, to the performance of your retirement savings if you're diversified internationally. Understanding these dynamics empowers you to better interpret financial news, make smarter decisions, and just generally have a better grasp of the economic forces shaping our lives. It's all about increasing that financial IQ, one step at a time. So, if you found this video helpful, and you learned something new today, please do me a huge favor and smash that like button. It really does help the channel reach more people. And of course, don't forget to subscribe, and hit the bell icon for more insightful content. We've got a lot more topics like this planned, breaking down complex financial ideas into easy-to-understand pieces. Let me know in the comments below what you'd like to see